Have you ever thought about investing in stocks but didn't know where to start? Well, you're not alone. Many people are intrigued by the idea of stock investing, yet they're held back by uncertainty and misconceptions. Let's get something straight. Investing in stocks isn't just for the wealthy or financial wizards. It's a financial strategy that can be used by anyone looking to grow their wealth over time. The potential benefits are substantial, from earning passive income through dividends to capital appreciation. Yet investing in stocks isn't without risks, and that's where education comes in. It's crucial to understand the ins and outs of the stock market, from the basics of what stocks are, to how to choose and buy stocks. Naturally, there are misconceptions about stock investing. Some people believe it's akin to gambling, while others think it's a surefire way to get rich quick. Both are far from the truth. In the following scenes, we will guide you through the basics of stock investing, so let's begin this exciting journey together. Before you start investing, it's crucial to understand what stocks are. So let's dive right in. Stocks, also known as shares, represent ownership in a company. When you buy a share of a company, you are essentially buying a piece of that company, making you a shareholder. As a shareholder, you have a claim on part of the company's assets and earnings. Now you might be wondering, why would a company sell shares of itself? Well, companies issue shares to raise money. This money can be used for various purposes such as expanding the business, paying off debt, or launching new products. There are two main types of stocks, common and preferred. As a common stockholder, you get to vote at shareholders' meetings and you receive dividends. Dividends are a portion of a company's profits that are distributed to shareholders. On the other hand, preferred stockholders have a higher claim on dividends and assets, but they don't get voting rights. Another key concept to understand is capital gains. Capital gains occur when you sell a stock for more than you bought it for. For example, if you bought a stock for $50 and sold it for $75, your capital gain would be $25. Now let's talk about public and private companies. A public company has sold a portion of itself to the public through an initial public offering, or IPO. Shares of public companies are traded on stock exchanges and anyone can buy them. On the other hand, shares of private companies are not available to the general public. So, to sum up, stocks represent ownership in a company. As a shareholder, you can receive dividends and possibly earn capital gains. Public companies sell shares to the public, while private companies do not. Knowing what stocks are is the first step in your investing journey. With this knowledge, you're well on your way to understanding the fascinating world of stock investing. Stay tuned for the next segment, where we'll explore how the stock market works. Until then, keep learning, keep investing, and remember, knowledge is power. Now that we understand what stocks are, let's delve into how the stock market works. At its core, the stock market is a marketplace. It's where buyers and sellers come together to exchange shares of publicly traded companies. These exchanges happen on platforms known as stock exchanges, with some of the most famous being the New York Stock Exchange and the Nasdaq. There's a lot of hustle and bustle in these exchanges. You have brokers who act as intermediaries between buyers and sellers. They're the ones who facilitate the trade of stocks, and for their services they earn a commission. Traders, on the other hand, are individuals or entities who buy and sell stocks, aiming to capitalize on short-term price fluctuations. Now you might be wondering, what determines the price of a stock? Well, that's where things get interesting. The price of a stock is largely determined by supply and demand. If more people want to buy a stock than sell it, the price goes up. Conversely, if more people want to sell a stock than buy it, the price goes down. However, it's not just supply and demand at play here. A multitude of factors can affect stock prices. These include the company's earnings reports, economic indicators, industry trends, market sentiment, and even geopolitical events. This complex interplay of factors leads to market volatility, which is the rate at which the price of a stock increases or decreases for a set of returns. Market volatility is a double-edged sword. On one hand, it can provide opportunities for profit. On the other hand, it can also lead to potential loss. It's this inherent risk that makes investing in the stock market both exciting and nerve-wracking. But remember, knowledge is power. The more you understand about the workings of the stock market, the better equipped you'll be to navigate its choppy waters. You'll be able to anticipate trends, make informed decisions, and ultimately, invest smartly. Understanding how the stock market works can help you make informed investment decisions. Choosing which stocks to invest in can be quite a challenge, but don't worry, we got you covered. The first thing to remember when choosing stocks is that research and analysis are your best friends. You wouldn't buy a car without checking under the hood, would you? Well, the same applies when investing in stocks. You need to understand the company you're investing in, its financial health, its competitive position in the market, and its future prospects. This is where fundamental analysis comes in. Fundamental analysis involves looking at a company's financial statements, its earnings, its debts, and its assets. It's all about understanding the intrinsic value of a company. Is the company overvalued or undervalued compared to its true worth? This can give you a good idea of whether the stock is a good buy or not. But that's not all. We also have technical analysis. This involves looking at charts and statistical trends to predict a stock's future price movements. You might look at trading volumes, price patterns, and moving averages. The goal is to identify trends and make investment decisions based on those trends. It's like trying to predict the weather by looking at wind patterns and cloud formations. Now let's talk about risk and reward. In the world of investing, higher potential returns often come with higher risks. That doesn't mean you should shy away from risk, but rather that you should understand it. What's your risk tolerance? Are you willing to invest in high-risk, high-reward stocks, or would you prefer a safer, slower-growing investment? Also, diversification is key. Don't put all your eggs in one basket. Spread your investments across different sectors and companies. This can help you mitigate risk and potentially increase your chances of gaining a return on your investment. In conclusion, choosing stocks isn't about picking winners based on a hunch. It's a systematic process that involves research, analysis, understanding risk, and diversifying your portfolio. Remember, investing is a marathon, not a sprint. So take your time, do your homework, and make informed decisions. Choosing the right stocks is a crucial part of your investing journey. You've done your research, and you've chosen your stocks. Now how do you buy them? Well, let's dive into that. The first step is to open a brokerage account. This is like your bank account, but for stocks. There are many online brokerage firms to choose from, each with different features and fees. Some popular ones include E*Trade, TD Ameritrade, and Robinhood. But you'll want to do your research to find the one that fits your needs best. Once you've chosen a broker, you'll fill out an application with some personal and financial information, and voila, you're ready to start buying stocks. Next, you'll need to place an order. This is where you tell your broker what stock you want to buy and how many shares you want. There are different types of orders you can place. A market order is when you buy the stock at its current market price. A limit order, on the other hand, is when you specify the maximum price you're willing to pay for the stock. If the stock's price goes below your limit, your order will be executed. If not, it won't. Each type has its advantages and disadvantages, so you'll want to understand these before placing your order. Now, once you've placed your order and it's been executed, congratulations, you're now a shareholder. But the work doesn't stop there. You'll want to monitor your investment regularly to see how it's performing. Remember, investing in stocks is a long-term game. Don't be discouraged if your stocks don't perform well right away. It's normal for the market to have ups and downs. And there you have it, the process of buying stocks. It involves opening a brokerage account, placing an order, and monitoring your investment. Remember, the key to successful investing is research, patience, and a good understanding of the market. Buying stocks may seem complicated, but with practice, it becomes second nature. We've covered a lot of ground today, so let's recap. We started off by introducing you to the exciting world of stock investing, explaining what stocks are, pieces of ownership in a company. We then delved into the mechanics of the stock market, a marketplace where buyers and sellers meet to trade these stocks. We also discussed how to select stocks to invest in. It's all about doing your homework, studying the company's financial health, understanding its business model, and keeping an eye on market trends. And finally, we walked you through the process of buying stocks, from setting up a brokerage account to placing your first order. It's been quite a journey, hasn't it? But remember, this is just the beginning. The world of stock investing is vast and ever-changing. It requires patience, diligence, and continuous learning. So don't stop here. Keep exploring, keep learning, and most importantly, happy investing.